So thank you very much for all the three talks, which were basically focusing on very specific topics, and this gives us the chance to ask questions in various directions. Well, one thing that I would like you to ask is that since Ester's taxi will leave in about 15 minutes, I would like you to address your first questions to Ester's talk.
In case there is any.
I think so. Okay, so maybe you have to switch on your microphones. Okay, so I will collect questions for the first round, and let's start here in the third row, Thorsten. And maybe you can briefly introduce yourself.
Yeah. Thorsten Nicher, Rhein-Waal, University of Applied Sciences. A question indeed to Professor Faia. So your talk was based on sentiments, and you used Google data to show the development and the reaction by the investors. My question is, do you have to take into account herding behavior? Why do I say that? Because I think we are mainly interested in bitcoins because there was a sharp upswing in the price of bitcoins end of 2017, and then some sudden drops afterwards. So my question is, how does your model explain that phenomenon, and whether herding behavior might be relevant, and also some technical problems of electronic platforms and fraud and illiquidity of the markets? Thank you.
Thank you very much. We will collect some questions. There was some question in the back, right?
Thanks, Gary Dimsky from the University of Leeds. Actually, I want to address something to Ester, but by way of connecting the three talks, which are seemingly disparate. But if we start with Amit's presentation, which shows the financial sector able to generate its own value in its own terms, and then we turn to Ester, who shows us the technology of doing that, independently, of course, constrained by electricity costs and Chinese regulations, maybe. But then we see then Martin giving a paper in which we see this endogenously growing, independent, possibly uncontrollable form of financial asset, increase, but to be hidden and unregulatable. We have huge worries here. We've got a sector that's out of control and is hiding the location and the site of the next crisis, but for sure we can know that the next crisis is going to come.
Okay, there was one question in front here by Sebastian.
Yeah, Sebastian Dulin, one of the members of the coordination group here, and this one of the two speakers. First question to Ester Faia as well. I was wondering, I didn't quite get how you are measuring sentiment. Google Trends, how can you get from Google Trends positive and negative sentiments about Bitcoins? And to Martin Hellwig, my question, one of the things you said sounded to me like you can have self-fulfilling speculations or in stock prices for banks, because you said Lehman Brothers, the repo markets looked at the stock prices, and maybe the stock traders or the short sellers looked at the repo market, and if they found out that Lehman Brothers wouldn't get the liquidity, they would dump the shares. So this reminds me a bit on the models we have from fiscal debt crisis. They are sometimes sunspot equilibria, so you have a good and a bad equilibrium depending on the expectation of the traders. And I was wondering what one can do against these self-fulfilling or multiple equilibria situations. Would you say we should outlaw short selling, or should there be some public agency which can intervene into the market and try to stabilize the expectations in the good equilibrium, or should we just accept what's going on there?
Thank you. I will collect two more questions and then I will close the first round. So there was one question here by Hans-Jörg.
Hans-Jörg Herr, Berlin School of Economics and Law. I would ask Mr. Hellwig, what do you think about the regulations after the subprime crisis? Do you think these regulations are sufficient? My impression is that the shadow financial system is only very lightly regulated, and international connectedness, international capital flows almost not. But I would like to hear your judgment about what was done.
Thanks. And then there's another one by Tom.
Tom Pally from Washington, D.C. My question is for Professor Hellwig. I like your advice. What's the story? So let me ask you, 1945 to 1980, very few financial crises, pretty stable. Lots and lots of crises, growing intensity, post-1980. What's the story?
Thanks very much for this round of questions. And I would like to start in the order from my left side to the right side.
Perfect. So I'm not sure it's on. I tried, but okay. So the rise of price in 2017, end of 2017. So our model is not designed to capture one increase of prices. So it's meant to capture the behavior of the markets. And so in fact, precisely for robustness, we check when we run our local projection of the AR that the results are robust to whether we include or take out that run up of 2017. And so what we are interested is mainly whether those two elements affect the increase of prices independently from some, strong shocks that might be just rare events, so to speak. I think the other question was how we construct sentiments. So we use the Google Trends, so basically the views in Google. And I mean, there would be two ways to do it. One would be to train a machine learning to check for words. But in this case, it's not really appropriate because what we are doing is something very simple. So we are just looking, we just separate words that indicate all positive searches about Bitcoin. So, like Bitcoin value is increasing or things like that, and said that we categorize as optimism. And then all views that are bad news about Bitcoin and that we categorize as pessimism. And then, of course, we do robustness checks on that by changing a little bit the threshold between optimism and pessimism. Yeah, I think that's basically...
Okay, maybe I can add one single additional question. Basically, your model says that after, so to speak, increasing competition, prices go up, right? So that's the interesting part of it. And you argumented that this is the case because supply is fixed in the end. So that was the story.
In the case of competition, the argument is that those markets have some surge friction, and so because of this, it's traders do not meet instantaneously, and so the market clearing condition has an impact when there is an increase on demand, but the fact that there are surge friction implies that even deviation from instantaneous trading can have an impact on prices. So in the case of miners, it's more their impact on the waiting times. So if there is more miners competition, because the miners are the ones performing the validation services, because I was asked before. So they are equivalent to banks in the payment system. The difference is that banks receive a monopoly power for that, while miners can enter freely. And so, the more miners enters, the faster are the transaction validated, and so the least trading frictions there are, and the more instantaneous is the trading taking place, and so more volumes are validated. So when more values are validated, you can say that this is akin to an increase in demand. Supply of Bitcoin is fixed, so through the market clearing condition, an increase in demand determines an increase in prices.
Okay, thank you very much. Then we go on with Martin.
Okay, I'll first try to answer, to respond to Sebastian Dulin. I don't think the multiple equilibrium issue was really key in the case of Lehman Brothers. The problem with them, as before with Bear Stearns, was they had thought for too long that they could securitize and sell the stuff that they acquired, and hadn't realized that the stuff had become unsaleable. So a lot of mortgages and a lot of MBS were accumulating in their accounts, and valuation of these securities simply went down quite drastically. They had very little equity and in fact were insolvent. Should one outlaw short sales, or should one outlaw trading on information? I don't think that that's all that helpful. Usually complaints about short sales come from managers of institutions that have been run badly. My point in introducing that fact was to show that we need to think about the complementarity between different securities and different markets when we talk about information contagion. And it's important for one academic strain of argument, such as it's wonderful if banks fund with a lot of short-term debt, because when bank managers are afraid that the short-term debt will not be renewed, will be run upon, they'll be really well behaved, because they know that the moment they misbehave, some creditors are not going to roll over the debt. There may be a run and they'll be out of a job. This Qualm Lake report, 15 very prominent finance specialists, in this case under the guidance of Doug Diamond and Raghu Rajan, contains explicitly the statement, don't require banks to fund with a lot of equity, because that comes at a cost, because you lose discipline on managers. If you ask the question, and why would anyone invest in the information needed to observe when the manager misbehaves? Well, that literature is silent, but when you see the stock market providing some information, you also know that as long as stocks are going up, nobody's going to bother. And therefore, the notion that this debt finance acts as a disciplining device on the upswing is just completely moot. Now, there were a number of questions about the scope for regulation. Have we had sufficient regulation? I've been going around for the past 8 years at least to say no. A few years ago at the Austrian Central Bank, I was asked by a former central banker why I used to dissatisfied with what we've done about regulation. And I asked the question, if all the regulations that we have now and have introduced since the crisis had been in place since 2000, would the crisis have been avoided? And before she could even think about the matter, another former central banker jumped in and said no. To give an example, we still cannot resolve big systemic banks if they're in trouble. If Deutsche Bank gets into trouble, I just hope that they're going to be bailed out, because otherwise it's a disaster. Why? They're systemic in London, in New York, and in Frankfurt. 3 different jurisdictions. The moment the authorities walk in, it's different authorities in the different countries. That destroys integrated operations, such as funding for operations in London and New York. European legal norms have no provision for liquidity in resolution. The idea is the authorities step in on Friday night, value the stuff on Saturday, write some debt down on Sunday, and by Monday the institution is deemed to be safe and all the money market funds are willing to fund it again. If the money market funds jump out, there's no source of money. That was why Banco Popular Español had to be sold overnight to Santander at a price that may or may not have been right. Who knows? They didn't have, even have time to figure out. That's why the Italians put the really bad stuff of the Venetian banks into a bad bank that was funded by Intesa, and Intesa got a guarantee against losses, because there was no provision for allowing anyone to wind down this portfolio slowly, the way the FDIC in the US had wound down the portfolios of the savings and loans institutions over 10 years, thereby much reducing the losses that were involved. On ex ante, the 3% leverage ratio that's the number that Lehman Brothers showed in the last balance sheet before they went bust. 3% is a very small number. Equity of major European banks was at 2 to 4% in 2007 and has gone back to 3 to 7%, which is where it had been in 98. Is there anything one can do? My belief is yes. Of course, the book, The Banker's New Clothes, says we need very high equity requirements. We give a ratio of 20 to 30%. I don't want to enter into the details of what that means, of total assets, meaning borrowing would be limited to 70 to 80% of what they buy. When you have that, liability is much more effective, and deleveraging reactions, deleveraging multipliers. What multiple of the loss must you sell when something bad happens are much smaller. Can this be done? I'm fairly sure it can, except there's absolutely no political will. And in my view, the major cost of the bailouts, which saved us from a repeat of the Great Depression, but they had a major cost, namely the industry was not sufficiently discredited as it had been in 1933, and therefore could play a major role in the writing of legislation after 2008. Basel III, which provides you with a tripling of equity ratios, was very much co-written by the industry. And of course, tripling something that's close to zero still doesn't give you very much, to quote the comment by Martin Wolf in the FT.
Thank you. Amit?
Well, I do not have a direct question to answer, but I'll just make one comment on story versus model. You see, when you have so complex a thing as was explained in some detail, and all of us know, one kind of approach is to look at it as a formally speaking, a network. The complexity of a network, which you can describe a network, or you can hide risk, or you can show risk, you can show contagion in different ways, and it will be different representations of networks, of a same physical phenomenon on the ground. But this complexity, I think, is if you look at the whole problem from the point of view of network theory, which, for example, the Bank of England does, and there are lots of studies on this, I think it is you can get stories, and every time it's a different story, as he was suggesting to some extent. This is one kind of approach, but you will not get anything to have handle on, It is like, the other thing is to try to look at a few macroeconomic variables. And that is the motivation which I have, which is not the most popular one, but which was the old-fashioned macro, or whatever you call it. You look at a few selected variables and see whether they can mimic, I would not say the real world, but whether they can mimic some of these abrupt changes. If they do, then those selected variables then look at more closely. And this is what I would suggest as the two alternative approaches. The first one is a complexity approach, and it has actually no answer. It has stories. The second one has answers, but it is an answer only in a mimic form. It only it is like a caricature of what the real world is. Thank you.
No. You may want to answer?
I'm not disputing the usefulness of models.
No.
We need models in order to understand the logic of certain effects, the logic of certain interactions. But I'm very worried that we all too often, or our profession all too often, mistakes models as being descriptive and uses them to talk about the real world, and uses the numbers in the models, identifies the numbers in the models with numbers in the real world, without thinking about what is actually going on in the real world, and how do we map the formalisms into the things that are going on. In areas where complexity matters, where you have lots of interactions that do not easily aggregate into something simple, there's no way one can get through without doing this extra step. And the one thing that worries me about the way we do policy analysis is that many people that do policy analysis have little consciousness of the fact that this is an entirely different intellectual exercise from thinking about a certain effect, thinking about a certain interaction, writing the model, running a regression, running an experiment. All of these are very partial and provide us with a zoo of ideas to take to our real-world analysis, but they're not a substitute for the latter.
Okay, thanks. We have some minutes left for a brief second round with very short and brief questions, and hopefully also very brief answers. So we start in the back. Yes?
So I would like to ask a question to Amit Bhaduri. My name is Dirk Beesman, University of Groningen in the Netherlands. I'm going to take your model to the real world, but with some adaptation, of course. So you said when profit is shifting from, let's call it the real sector, to the financial sector, and you have a drop in share prices, that's when you're in for a financial calamity. Did I understand that correctly? You can correct me if not. And so then my question is, but we did have a long-term shift in profit towards the financial sector for decades. And in those decades, we had several drops in share prices. Some led to calamities and others did not. So isn't there a variable missing? And you know, especially Minsky would suggest that you can't understand the financing of financial capitalism without looking at the financing structure. So my brief question is, isn't it, so where are the financing structures in your story, and do they not determine whether or not a fall in share prices or a shift in profit will lead to financial calamity? Thank you.
Mm-hmm. Thank you very much. And in the front, Professor Sheffield.
Well, my question is actually quite similar and also to Amit Bhaduri. So I should like to invite you just to clarify these matters, to compare your theory to the old overinvestment theory of the business cycle, where you also had the shift of profitability when the rate of accumulation would go down on the one hand, and on the other hand, you had rises in interest rates and difficulties in the financial sector. You explain it here in terms of the drop of share prices, but nevertheless, it seems to be a similar matter. So do you want to explain the old theory in a new way, or is it a new theory?
So there's a chance for 2 more questions if you want. There in the front. Philip.
Philip Arestis from the University of Cambridge. A quick comment on what Hellwig said. Macroprudential policies had been abandoned prior to the gross... sorry? Is it better? Global financial crisis. And in fact, some central bankers, especially the IMF person, the Federal Reserve before the financial crisis, the best way to avoid the financial crisis is not to have controls. Leave it to the markets. Post GFC, global financial crisis, we had proposals. Dodd-Frank Act in the United States, Vickers report in the United Kingdom, Liikanen report in Europe, the IMF report or proposal, the Basel III. But all of them seem to have been ignored. Consequently, is it the case that the central bankers still believe that markets know best and do not interfere? Thank you.
Thank you very much. So I'm closing the list now, and we have our 2 speakers again to respond. Maybe Amit should start.
Yeah, I have a very direct answer because this is something I have thought about earlier. You see, you are absolutely right. Whatever data we have does show a long-term shift in favor of the financial sector in terms of profit share. You know, things were published even after 2007. First, this data was systematically published, and now many people think of it as one of the characteristics of financialization. So there has been a shift if you think in terms of what I was trying to say, shift in favor of the financial sector in terms of profit share. But at the same time, if you look at the asset price, in this case proxied by a very simple average share price, if you think of the financial asset price, that financial asset price has moved around quite a bit. It has gone up, gone down, there have been temporary changes. Now, what if an abrupt change, to answer exactly the question, an abrupt change, if this kind of reasoning is correct, has not missed out something very basic, an abrupt change would basically mean asset prices moving in one direction, the average asset price index moving in one direction, and the share of profit to the financial sector moving in the other direction. This has happened. As a matter of fact, this happened in 2008, and the first one to point out was a Marxist economist. I mean, he brought in labor theory of value and all the rest of it. But the data was quite interesting, which was which is what I'm trying to suggest. The early warning system in terms of a few variables. This is a very clear example of what I was trying to say. Regarding the business cycle, I think you see in, not real business cycle of modern times, not the Kidman, but if you take standard endogenous business cycle models, Kaldor and, Kaletsky and all the rest of it, and also later ones, Frisch, Ragnar Frisch, onwards, the whole class of business cycle model. There you see the, how shall I put it, the constraint comes from outside. Basically, it is introduced by, the capital stock is too high or something like that. There is a ceiling and a floor which you separate from the business cycle. Nobody has even been able to show, that how endogenously you can incorporate a ceiling. In the financial crisis or whatever you call it, the financial cycles of this kind, there is a long-term trend which we call financialization, and there is a regular cycles which are going on for whatever reason, speculation, sentiment, whatever name you want to give it, regular cycles which are going on. And these two at every point have not movement in the same direction. This you can very easily see in the statistics. And that is what motivated me, motivated to try to formalize it in the way I have tried. That you probably have an early warning system when you see that for example, share prices are rising, but the profit which is being transferred to the financial sector is falling, or the other way around. This kind of contradictory movement is probably what is a very important indicator of a systemic risk. That's what I was trying to say. And that is endogenous. That's not like cycles, traditional business cycles.
I appreciate and have been much concerned by the way in which, in some institutions, market ideology has dominated everything else. Now, concerning the warnings before the crisis, Rajan, Schiller, IMF, none of them said anything about systemic repercussions. It was all about subprime and US real estate is a problem. And the unique feature of this crisis relative to, say, the Japanese crisis, the S&L crisis, the Swedish crisis, was contagion. And nobody anticipated the extent of contagion and the damage that the contagion would have done. Do they still believe that markets know better? In the overall environment, you have lots of people who believe that markets know better. Somebody was talking about the deregulation that's again setting off. But the media are an important part of that. I remember in the fall of 2006, I participated in an evaluation of the financial stability group of the Swiss National Bank. And they told me, or told us, we're really bothered by the low equity ratios of our two systemic risks, UBS and Credit Suisse, below 2% of total assets. They tell us there is no problem and no risk because everything is so nicely hedged and calibrated. If we talk to the supervisor tells us the bankers know. If we talk to the finance minister tells us, don't harm our national champions. If we go into the public, next day we'll have the entire Swiss press blaming us for harming our national champions. So the media and the heroization of major financial institutions is a major part of this problem. And any journalist at a results conference who asks one of the bankers, why is your rate of return on equities so low, without adding the comment, is this because you were careful not to take too many risks, is contributing to that game. We communicate about ROE and we don't communicate about risk. So what you're talking about, the statement, markets know better, is just one tip of the iceberg of an entire system of social communication where the industry has it very easy. In terms of the reform debate, I would like to add that one reason why regulatory reform did not go further was because of what I call the Iraq effect. On September 12th, 2001, Mr. Cheney and Mr. Rumsfeld knew, in quotation marks, that Iraq had been culpable. Iraq was always the center of terrorism, and therefore Iraq must have been the culprit for 9/11. So the European Commission knew that a lack of European integration was the reason for the crisis. Mr. Steinbrück knew that the locusts were a cause of the crisis, none of which was true. And I'm afraid that the political energy which the European left has spent on the financial transactions cost, financial transactions tax, falls in the same category. Speculation, in particular high-frequency speculation, had nothing to do with the crisis. And by not focusing on the things that really mattered in the crisis, we've wasted an opportunity.
Thank you very much. So we would like to thank all our three speakers, even though only two are still here, for their interesting presentations and for all the questions and answers and the nice discussion that we have. So thanks again.